Your salary might not increase, but your country's bill just did. India is spending more dollar than it earns. How long before that hits your money? That question is more important than most people realize, because when a country consistently spends more than it earns, that pressure doesn't stay at the macro level. It flows downward. And by the end of this video, you will understand what a widening trade deficit really means, why oil imports are critical, how this connects to rupee pressure, and whether your inflation risk is quietly building or not. Stay with me till the end, because this is not just an economic statistic, it is structural pressure. Now let's simplify this. A trade deficit happens when a country imports more goods than it exports. India imports crude oil, electronics, machinery, defense equipment, gold, and industrial components. All of these are largely priced in dollars. When imports exceed the exports, India needs more dollars than it earns through export. That gap is called as the trade deficit. Now pause. Imports must be paid in dollars. So when the trade gap widens, demand for dollar rises. And when demand for dollar rises, pressure builds on the rupee. You have already seen what rupee pressure does. It increases the import cost. It increases the inflation pressure. It affects the fuel. It affects transport. It affects everything downstream. But here is the part most people understand or understand in a wrong way. A trade deficit by itself is not a crisis. The real issue is sustainability. If India's imports are rising because of the economy expansion, factories are buying machines, infrastructure is growing, investment is accelerating, then a wider deficit can reflect the growth. But if imports are rising mainly because oil prices are high or commodity prices are inflated, while exports remain stagnant, then the pressure builds. Now, here is the second layer. When a country runs a trade deficit, it must fund it. How? Through capital inflows, foreign investment, portfolio flows, external borrowing. If capital inflows are strong, the deficit is manageable. If capital inflows slow while the deficit widens, currency volatility increases. And when currency volatility increases, markets react. Now think about it personally. If the rupee weakens further because dollar demand rises, what happens? Imported goods become more expensive, fuel costs increase, inflation pressure builds. Even if your current salary stays constant, your purchasing power falls. Now, this is how macro pressure trickles into daily life. Now, here is where it connects to the market. If the trade deficit pressure rises sharply, rupee becomes volatile, bond yields can rise, inflation expectations shift, rate cut hopes get delayed. And when rate cuts are delayed, valuation expansion slows. Markets don't crash because of a single number, they reprice because of trend acceleration. The key word here is acceleration. Is the trade gap stabilizing or is it widening faster? Acceleration matters more than the existence. Now, let's address oil. India imports the majority of its crude oil. If oil prices rise while the rupee weakens, the pressure compounds. Higher oil leads to higher import bill. Higher dollar demand, then it leads to weaker rupee and higher inflation rate. Now that cycle matters. Now, here is a question you should be asking. Is this deficit temporary, driven by seasonal imports or one-off factors? Or is it structural, driven by persistent imbalance? Because structural deficits demand structural solutions. Temporary deficits demand patience. Markets try to detect the difference early. Now, let's bring it back to positioning. If trade pressure builds but capital inflows remain strong, stability holds. If trade pressure builds and capital inflows weaken, vulnerability increases. That vulnerability reflects first in currency market, then in bond market, then in equity volatility. Now, here is the calm perspective. India is a growing economies import more, that's normal. The issue is proportion. Is the deficit widening relative to the GDP, or is it manageable within the growth context? Because a 2% imbalance is different from a 6% imbalance. Context changes everything. Now let me bring this to you directly. If the trade deficit trend worsens, you should expect rupee volatility, expect inflation conversation, expect policy caution, and you should expect market sensitivity. If it stabilizes. The pressure eases, currency stabilizes, market confidence improves. The headline is not the risk, the trajectory is. If you want macro explained before it hits your portfolio, subscribe. Because most people notice inflation after it rises, most people notice rupee risk after it falls. But disciplined investors watch pressure building before it explodes. And that's what we do here.